Alrighty, hello everybody, and thank you for joining us for today's webinar. Today's webinar is part of our free education webinar series, and I am joined today with our presenter, Melisa Silverman. She'll be talking today about the difference between value and certified value. A few housekeeping notes and a little background on Melisa before I turn it over to her. First off, my name is Drew English. I am part of the Exit Planning Institute. I will be facilitating the webinar with Melisa today. A little bit about Melisa. She's the partner in the Founders Group, which is a national company focused on providing business transition services for closely held companies using a holistic and collaborative process. She's also the president of the Avenue M Advisors, which is a national boutique business valuation and consulting services company. Also, Melisa is our president of the Greater Los Angeles chapter out in California, and she's been a very active SEPA as well in the industry. So hopefully everyone can pay attention, learn some stuff from her today, and hopefully can take this and move forward with it as well. So a few housekeeping notes before I turn it over to her. One, the webinar is being recorded, so the recording of the call will be sent out later today. So just look for an email from myself with that link. You're going to want to click the link and choose to download the file, which will allow you to listen to the webinar in its entirety. Two is the question box. So during these webinars, we ask that they're very interactive. We ask for many questions, comments, chats, anything like that that you would like to put towards the group. We definitely recommend those coming in. You can put those in on your drop-down menu of GoToWebinar. There's a questions box. Go ahead and type those questions or comments in there. Then I'll facilitate those over to Melisa at the end of the call. So with that, I'll go ahead and turn it over to Melisa. We'll get into the webinar today on the difference between value and certified value. So Melisa, it's all yours.
Thanks so much, Drew. So welcome, everybody. Thanks for attending this session. I don't know if it's morning or afternoon, but good day to everyone. So let's get started here. I know Drew gave some background about me, but just to give you a little bit more information about myself and my background and the companies that I'm with. So Avenue M Advisors is a boutique national business valuation company. And as you can see here, we do many types of business valuations. So we do everything from investment valuations, which include transactions, ESOPs, any person who's looking to buy a company that's looking to have those companies assessed or analyzed. We do tax-related valuations. So that includes things like 409A valuations. We're going to talk more about that. Companies that are converting from a C to an S Corp, any type of audit situation. They might be doing some state tax or gift tax value. They may have a need for those valuations. There are financial reporting valuations. Sometimes if companies have just acquired companies, they need to have a purchase price allocation valuation done. Or maybe they need to determine if there's any goodwill impairment in the company. And we also do some litigation support valuations. So there's a lot of different types of valuations that we perform as part of this company. And all of the valuations that we do are certified. They are compliant with industry standards, which is we comply with USPAP, which is the Uniform Standards of Professional Appraisal Practices, as well as our designating organization is NACVA. And we also meet the regulatory agency requirements, including the IRS, the SEC, ERISA, and the Department of Labor. And you'll see that for some of these valuations we're going to talk about, these are really important regulations that we have to meet. So that company, Avenue M Advisors, is my company. And then I'm also a partner in the company called Founders Group. And the Founders Group actually came to be out of exit planning. I saw my partners, I've known them for a long time, but I saw my partners at an EPI summit meeting a couple years ago. And from that, we actually got together and saw we were going down the same path. And we decided to form a really comprehensive practice around exit planning that is comprised of all these different professions. So comprised of the founders group we have 2 tax attorneys and trust and estates attorneys. We have an outsourced CFO, someone who does turnarounds and really helps companies to grow. I have a valuation background and a legal background. And then we also have someone who has a marketing background, and she's a culture expert. So we brought all these different skill sets together to form the founders group. And so we're a national firm that focuses on helping business owners prepare for the transition of their business. And so the process that we created in our company asks and answers 4 questions for business owners. Where are you right now? So that's understanding everything that they have in place. Where are you going? And that's all about doing some strategic and tactical planning with the business as well as with the family. How will you get there? That's all about, if you've been through the SEPA program, that's all about those the improvements that we make to the business. So the 90-day sprints, that's how we get there. We help them to make those improvements. And then what's next? What's next is, are they going to transition the business? Is that going to be through a sale? Is that going to be internally to their children? It might be an ESOP. So what's next is all about that transition, as well as what happens post-transition. So that's what what's next is all about. Now, in our in Founders Group, we also do certified business valuations, which is why we thought it was really important to bring this topic and talk about that today. So here you can see some of the topics that we're going to discuss today. I'm not going to go through it, but let's get into it. And again, as Drew said, if you have any questions, please feel free to ask your questions, and I'll try to answer all of them for you. So let's start with the exit marketplace and how valuations fit in. Right now, as hopefully everyone is seeing, you know, there are these baby boomers that have a lot of businesses, and they are getting ready, or they are preparing right now, or many of them are not preparing for what happens when they exit their business. And the demographics really show that this is, there's just a multitude of these companies. And we also are seeing that we're really in a bull market. We have very low interest rates, and we've been in this bull market for a period of time. So the market conditions are really right now for business owners who want to exit their business to do so, and to do so in a really great way. We are seeing that there's a lot of consolidation happening in the market. Companies are looking for vertical integration to help expand in the right ways. They're also looking to get economies of scale in their business through efficiencies and all that. We have new tax laws that came into place this year that are having a positive impact on business owners being able to exit their business and exit in a way that that's positive for them right now. There's a lot of money out that's around that is available for acquiring the right companies. So there is a lot of money on the sidelines that they are looking for the right deals. And we're also seeing high multiples. So we haven't seen high multiples like this in quite some time, and it's been year over year for the past number of years. So this is some of the reasons why there's a lot of valuations that are being done, and a lot of it's around exit planning and or something having to do with their exit. So let's talk about some of the reasons that business owners have a need for valuations that are not related to an exit. So some of these include companies that are seeking financing, either from the bank or from investors. And in that case, a lot of times investors will require a company to have a valuation done because they want to really see how the business is doing. Another reason, we talked about the 409A, and I said I was going to explain that. When companies grant stock options, or they have a phantom stock program, or they've done a Series A or B financing round, they need to have a valuation done. and the valuation is actually for 409A purposes. 409A is an IRS code section. It's not going anywhere, and it requires that when companies are granting options or have these preferred financing rounds, they need to, the stock options at least have to be granted at fair market value or above. Cannot be below fair market value, because that creates tax consequences for the company and for the employee and opens the company up to other liabilities. So that's the reason for these valuations. And this code section is not going anywhere. I know companies do not like this, but it's a necessary situation to protect employees. And the requirement around this is that if you're granting stock options or phantom stock, you need to have these valuations done at least within 12 months of granting those options. Another reason is a lot of companies or business owners are making gifts. This is a really good time to be able to transfer shares in your company from the owners to family members or to charities or those things. And those require that a valuation be done of the interest that's being transferred for gift tax or charitable tax reasons. So that's another reason. And then, of course, a lot of companies have intellectual property or goodwill. Intellectual property could consist of patents, trademarks, copyrights, might be proprietary software or processes. It could be trade secrets. There are a whole host of things that could comprise intellectual property. Now, these valuations may be done for internal purposes. It could be done as part of an exit, or it could be that the company is looking to spin off the intellectual property into a new company. So there's a lot of different reasons why intellectual property is being valued or might be valued. Another reason we talked about is conversion from a C Corp to an S Corp. With the tax changes that have occurred, it's going to be interesting to see whether we still have a lot of these conversions. But there's a lot of reasons why companies convert from a C Corp to an S Corp. The number one reason is because of that double taxation. So to convert to an S Corp allows them to get rid of some of that additional tax. Now, with the lower taxes for C Corps, it's going to be interesting to see what happens here. And then, of course, there's notes. If companies have any, or business or anybody have any notes or security interests, there are a lot of reasons why those notes may be, or security interests might need to be valued as well. Now, some of the reasons related to exiting, again, business owners who are exiting their business, as part of the planning process, there is a lot that can be done to set up the right types of trusts. And in those situations, you can gift part of your shares prior to an exit into these entities that are going to allow you to get a lot of tax savings. So in those situations, again, you need to have a gift or a charitable donation valuation done of the interest that's being transferred. And that's of a business. That could be real estate or any other type of security interest that might need to be valued. You have, at least as far as for state tax purposes, if the person passes away and they have a large enough estate, then you might need to have the estate tax valuations done. Now, more readily, we're seeing it being done for income tax purposes as opposed to estate tax purposes. But in any event, these valuations are still being done because we need to know what the basis is of the interest for the person who passed away. Then again, you have the sale or an exit of a business. That's the reason we're all here today, and we're going to talk a lot more about it. But valuation should be done for this purpose, and it should be done multiple times. It should be the starting point for the planning, and then it should be done as you are getting into the planning as well. There's reasons why you should have multiple valuations done. ESOPs. Hopefully everybody's familiar with ESOPs, and ESOPs are employee stock ownership plans. This is an internal exit. This is when owners of the company actually sell shares to the employees of the company, and it's held through an ESOP trust with a trustee that manages the shares for the employees. So this is another reason, and ESOPs are heavily regulated. They're under ERISA, and there are valuations need to be done on an annual basis for ESOPs. And if you're going to put an ESOP in place, you want to make sure you're working with advisors that are familiar with ESOPs, because there are a lot of specific requirements around valuation that need to be followed for ESOP valuations. Then again, there's management buyout. So a management team might come in and they want to buy out the owners in the company. Typically, you should have a valuation done. Management team doesn't want to overpay for the company. Recapitalization of the company, restructuring it typically requires a valuation as well. And then, of course, buy-sell agreements. We do a lot of these because if you have partners in a company, you have to be able to say how is one partner going to buy out the other company or the other partner. So that's another reason. So now let's talk a little bit about the types of valuations. There are different types of valuations that we perform. The simplest is typically an asset valuation. And asset valuation is basically the value, what's the value of the tangible fixed assets and intangible assets of the business. So this is typically your fixed assets, other assets, plus your goodwill. Now, typically, when we're looking at an asset valuation, the business owners and the seller and the buyer are going to determine what assets are being transferred as part of a sale. But what's important here is a lot of business owners do not get their business valued, especially when they're doing a sale of an assets. And the reason for that is they think that they know what the fixed assets and what the total value of their company is worth. But we underlined here the intangible assets. In most companies today, the majority of the value in the company is really in these intangible assets. And that's the value that the business owner does not know and doesn't have a good understanding of. And that's where you have most of your sellers that leave a lot of money on the table because they didn't understand what the value of their business was or is. Then you have equity valuations. And equity valuations is what's the total stock price or what's the total fair value of the equity in the business. And the other type is an equity with discounts valuation. The only difference between equity valuation and an equity with discounts valuation is an equity valuation is to fair value, and it does not take into consideration any discounts. Discounts are taken when you have a minority interest. Now, you could also, there are discounts that apply for majority interests as well, depending upon what restrictions there are in the company. But in equity with discounts, we're typically looking at the fair market value of a minority interest, or it could be of the majority interest. But we're looking at discounts for lack of control and lack of marketability. Lack of control means that they can't make decisions for the company alone. And lack of marketability means that they cannot, well, there's no open market. It's not a public company, so there's no available market with which to transfer or sell a partial interest. So because there's no available market, an investor typically does not want to pay full price for that interest if they're buying a minority interest. We also have 409A valuations. And with the 409A valuations, there are typically different types of equity classes that we might be valuing. And each equity class has its own analysis that gets done. So typically you might have preferred shares, and there might be different classes of preferred shares. You could have seed series, which is basically like friends and family. You could have a Series A preferred shares. You could have Series B. You could have Series C. You could have multiples of Series A. And each of these classes have different rights and restrictions that go along with them. So, and there's different rankings that go along with them. You also have common shares. You might have convertible notes. Those convertible notes could convert into preferred shares, or they could convert into common shares. You might have warrants. Again, they could be preferred warrants or common warrants. And you might have stock options as well. So the purpose is to determine what the fair market value of the common shares and the stock options is. Because again, you can't grant stock, you shouldn't be granting stock options. It has to be at fair market value or above. So that's what we're just trying to determine there. But in order to determine what the value of the common and stock options are worth, you have to value the preferred shares first. So that's why all those other equity classes have to be valued prior to determining the value of the common shares. So let's get into some valuation principles. You know, typically a valuation, hopefully you're all familiar with valuation, but it's basically a defensible opinion of value of what the tangible and intangible assets of a business are worth. It's typically performed as of a specific time period. So I look at it as typically it's a snapshot of a business at a specific point in time. We're not looking at a whole year. We're just looking at it as of one date and time, and doing the valuation, all of the analysis around that. When we do valuations, you know, we talk about the discounts that get applied, and those discounts are for lack of control and lack of marketability. But there's also control premiums that may be applicable as well, and we have to do an analysis to determine if there are reasons to apply a control premium. First of all, the owner that's acquiring the business may be acquiring a control, you know, the entire company, in which case there should be a premium that gets applied. But there may be other reasons for a premium to be added as well. And so we have to do that analysis to determine if we should be including a premium or if we should be taking discounts. And those discounts could be for lack of control, lack of marketability, but it could also be because the company has taken on a large amount of debt, which is going to reduce the value as well. So we have to look at what it is that we're valuing and determine what kind of premiums or discounts we should be taking. Now, when we talk about standards of value, because standards of value are very important in valuation, what you're seeing here, these are the typical standards that we typically use in valuation. The most common one is fair market value. And fair market value, as you can see here, it's the price that an asset would change hands between a willing buyer and a willing seller, with all the parties not being under any compulsion to buy or sell, but also having all of the information that they need to be able to make an informed decision. Fair value is essentially the same standard as fair market value as we talked about, but we're not applying any discounts. But then you also have investment value. And investment value is when you have an investor that might be looking to invest in a company, they may have particular set of parameters that they want the business to be valued based upon. And so we take those parameters and we'll do a valuation around it. And we call that investment value. And then you have liquidation value. So if a company is in a distressed situation and we're trying to determine what the value of the assets would be if we were to sell them piecemeal, that's essentially liquidation value. And liquidation value can be either orderly, so we have time to sell off the pieces, or it could be forced. If it's orderly, it's going to have more value than if it's a forced sale and we have to just sell it at auction and get whatever we can for it. So I wanted to provide a hierarchy here that kind of shows you the different types of buyers and situations out there and what value typically is applied to that situation. So you can see here that if you have a strategic buyer is typically done to investment value. It could also be fair value, but there's a reason why a strategic buyer is looking to invest in a company. And if they are looking to acquire a company, it's usually because they see a reason to pay more. So we typically will do that to investment value. Financial buyers and control interest, if you're buying 100% of the, or a little bit less, those valuations are typically done to fair value. Now, when you get into minority interest valuations, that's always done to fair market value. And when we look at ESOPs or stock options, those are always done to fair market value. An ESOP is not allowed to pay more than fair market value for the shares that it acquires. And if you're acquiring a company, it can't pay more than fair market value for that company. And when you're looking at a bankruptcy or a distress situation, obviously we're looking at liquidation value. Okay, so just some additional principles here. The purpose and use of the valuation is always really important when we're doing different types of valuations because it sets the parameters of what we're going to be doing. So is the valuation for investment purposes? Are we looking to sell the business? Or is an investor looking to invest in the business? Is the company seeking financing from a bank or maybe from another investor? Is the company issuing or granting stock options to employees or other consultants? Or is there a buyout that's taking place between partners? The purpose of the valuation is going to tell us one, what type of valuation we should be doing, and then the use of the valuation is going to be telling us whether or not we should be trying to. So when we do a valuation, there's always a range of value, and the use is going to tell us should we be on the high side of the value range, should we be on the low side of that range, or should we be somewhere in the middle? Some other things that we always have to identify: what is it that we're valuing? Are we valuing the assets in the company? Are we valuing the equity, the stock in the company? Or maybe we're valuing the intellectual property. We have to understand what it is that we're valuing. We also need to know what are the approaches to value that we're going to be applying. So we have different approaches to value that we can use to value different types of companies. If a company is a mature company, we have a lot of options that are available to us. But if a company is a startup company, or if it is a distressed company, then there may only be a couple of approaches that can be used to value those companies. So that's going to affect what we do. We also need to understand what issues are there that could affect value. And we have to address those. We have to analyze those situations and determine how best to handle them inside of the valuation. So some examples might include if there's litigation, if there's pending litigation that's going on that could significantly impact the value, we have to address that. If there's been subsequent sales that have occurred, we have to take that into consideration if it's close enough to the effective date of the valuation that we're working on. So there are different things that could impact. I'll give you an example. We did a valuation of a medical practice where there was a pending litigation going on that had the potential to impact the business. I think that the litigation was a couple million. And so we had to take that couple million of potential damages into account when we were determining what the value of the company was. Again, we also have to identify whether any discounts or premiums are going to be analyzed as part of the valuation. Now, something that you want to know is when you're looking for a valuation firm, you want to really understand and you want to go through with them their qualifications, because you want to make sure that you're working with a valuation firm that has experience with the type of valuations that you're looking to have done, and that they have the credentials to do and to perform the type of valuation that's being done. So if it's something that's being done for IRS, or the best example I can give you is an ESOP. An ESOP is highly, highly regulated. It falls under the Department of Labor. The Department of Labor is very active with doing audits of ESOP companies. And there have been a lot of litigations around valuations of ESOP companies. So there have been a number of settlements that have come out in recent years that have provided a step-by-step procedures for how valuations are to be done, and how valuation firms should be working with trustees and all that, and the company. And so you want to make sure that you're working with a firm that understands all of these requirements and has experience performing these types of valuations. So these are the questions that you should be asking. And you should also find out, what other services do they provide. So if you've got a valuation firm that also is doing investment banking and they're working on the same transactions, that's a huge conflict of interest, and that could create problems for your clients. Be really careful of that. And you also want to get references from these firms and check them out. Make sure that they're they do really good quality work. So now let's get into, we talked about the fact that this is talking about valuation or recasted financials versus certified value. So hopefully I've given you a lot of background into, what certified valuations are all about, what is comprised of valuations. Now let's get into talking about the difference between recasting financials and having a certified valuation. So when you talk about recasting financial statements, this is done extensively by business brokers and by investment bankers. This is how they get started when they work with their clients. They basically are going to recast the financials and come up with a value to say, this is the starting point. This is what we think, just based on looking at your financials, this is what we think your business is worth. And so how it works is they start with determining what the EBITDA is in the business. And the EBITDA is earnings before interest, taxes, depreciation, and amortization. That's where they start. And then what they typically do is they're going to make adjustments to the EBITDA to normalize the earnings for the company. And what the typical, when these companies do the adjustments, they're usually looking at officers' compensation. They'll look at owners, the perks that the owners receive. And these perks are the company's paying for them, but they're getting them personally. Non-reoccurring expenses are a big adjustment that gets added back. Non-reoccurring expenses could be anything like legal expenses for litigation matters, accounting expenses for litigation matters, or it could be a transaction. Companies don't typically do transactions every year. Now, sometimes they do, but a lot of times they don't. So your costs around those transactions are typically non-reoccurring expenses. There's other types of adjustments as well, but these are typically what gets added back when you're recasting financials. And then what ends up happening is we take the normalized earnings after we've made the adjustments, and we're going to multiply it by a business multiple, and that's going to be the value of the business. So let's look at an example. So here's an example where the business is generating about $7 million in revenue a year and has EBITDA of $650,000. They have depreciation that totals about $50,000 a year. The owner draws a salary of $400,000, but in addition to the owner, The wife is also drawing a salary of $100,000, and she does not work in the business. You have travel expenses, which include 3 family vacations that total $30,000. You've got owner's family health insurance and a life insurance premium that totals about $25,000. And then you've got a building that the company owns, but it's owned by the family and it's owned by a separate entity. And the company is actually paying rent, but it's nominal rent, so it's under market value. But we know that the current market rent is, so while the company's paying $2,000 a month, the current market rent is $6,000 a month. And then you've got some non-recurring legal fees for a lawsuit that total about $80,000. So normally I would ask all of you, what would you do with this? But since we're on a webinar, let me show you what we do with this. So this is a recasted financial statement. And what you can see here is we start with the EBITDA, which is $650,000. And then we go and we look at the add backs. Depreciation is a typical add back that gets added back to the company. Owner's salary typically will be added back. The wife's salary is going to be added back as well because she's not working in the company. So that's a perk. The travel is being added back because those were for family vacations. Again, it's a perk. The insurance benefits are being added back for 2 reasons. One, the family insurance is another perk, but officers' insurance premiums get added back because the company's paying for that as well. So that's another perk. And then, of course, the legal fees are your non-recurring expenses. So you can see here that when we get done, their normalized earnings are $1.3 million. Now we're going to deduct the fair market value for the owner's salary. And you can see here that instead of it being $400, we think he's being overpaid. So we believe that for that salary or that position, the fair market value salary would be about $250,000. And then we're going to also make a rent adjustment for $48,000 because remember that the family owns the property, but the company is only paying $2,000 when market rent is $6,000. So we have to add back that $4,000, and on an annual basis, it comes to $48,000. So now you've got adjusted normalized earnings of about $1,037,000. Now, if we take a multiple, let's just take a multiple of 4.2, and we factor that in with the normalized earnings. Now we're at a value of about 4.4 million, and that's what the recasted financials result in. Now, the original EBITDA was only 650,000. If we took the original EBITDA and we adjusted it for the multiple, you would see that we would be only at 2.7 million, which is resulting in a difference of 1.6 million. So you can see that the recasting is increasing the value of the business. The problem with it is that if you just recast the financials and you don't do a comprehensive analysis of the business, there is so much that you're not taking into consideration. You're not taking into consideration any of the intangible asset value at all. You're not looking at any intellectual property value, and you're not looking at any goodwill value at all. And so that value may be low for those reasons. It's not looking at the company's performance against the industry and seeing how is the company performing as compared to the industry. Because in that instance, if the company is outperforming against the industry, then that value could be way too low. On the other hand, if the company is not performing as well as the industry, then that value may be overstated. And it's not, so we have to look at this as a starting point for determining what the value of the business is, and that's what recasted financials do. Now let's just talk about some of the pros and cons here. So the pros here are, it's typically low cost. A lot of times it may not cost anything to have this done, or it's relatively low. It can be done very quickly. and it provides the owner some indication of what the value of their business is. The cons are, we talked about these. You don't understand what the intangible asset value is, and typically, in most companies today, in the world we live in, that's what the majority value is comprised of in these companies. We also haven't done any comparison against any market comps. So looking at other similar types of companies that have sold and analyzing, what should be the appropriate multiple to use for this company. So again, it provides some value, but not a lot of value to the business owner. So now let's talk about, what do you get with a certified business valuation? Well, again, you're meeting the certified valuations meet industry standards and regulatory standards. So they meet USPAP and NACFA standards and other ASA and other AICPA standards. They also meet the IRS, SEC, DOL, all of those regulations, and that's really important in a lot of instances. If these valuations get in the hands of them and they don't meet the standards, the companies can face penalties, and there's a whole host of things that can happen. Also, when we do these valuations, when we do the income analysis, we are typically looking at what are the strengths and weaknesses of the business. We're doing a comprehensive analysis of the entire company to see how that company is doing. When you're just recasting financials, that's all you're doing is you're just looking at the financials. You're not really analyzing where are the strengths and where are the weaknesses of the company. We also, when we do a valuation, a certified valuation, we're determining what are the appropriate cap rates and risk rates that should be used and analyzed as part of the valuation. If we're doing a discounted cash flow analysis, which is essentially where we're looking at the company's projected earnings for future years to determine what the present value of that business worth. And that's what a valuation is all about. It's all about looking at the projections. It's always looking forward and as to what the current value of the business is. Also with certified valuation, with recasted financials, all you're doing is looking at the financials and making some adjustments. When we do a certified valuation, we start with the market comparison approach. And typically, we're going to be comparing the subject company to other privately held companies. We also will compare them to guideline public company comparisons and analyze them, take into consideration the size differential and all that. And we typically will come up with relatively sound values for the business. Again, we talked about the income analysis. Under the income analysis, we can look at the value drivers of the business to determine what should be the appropriate cap rate that gets used to determine a value for the business. We also do a discounted cash flow analysis to determine a value for the business. And then if the business, I mentioned earlier that there are some times where we can only use a couple of methods. If a company is a startup company or if it's in a distressed situation, then the only ways we can typically value that company is either to use a discounted cash flow analysis and or to use the replacement cost. And the replacement cost is essentially what would it take to replace or to bring the company to the current situation that's in right now. So we're trying to determine that replacement cost value for the business. So when we take a look at value drivers, these are all things that are going to be increasing the value of the business. So, we want to look at, historical trends, the historical revenues, and whether there have been profits historically. So we want to see what those trends look like. Is it trending up? Is it trending down? What does that look like? We also want to look at Does the company have projections in place? And if they do have projections in place, are they reasonable? Projections are really interesting things these days because many companies have them, but they're not realistic. A lot of your startup companies will develop projections and they're kind of pie in the sky. You have no idea whether or not that company is going to meet their projections. I talked earlier about ESOPs. I talked a lot about ESOPs, but the reason we're talking so much about ESOPs is because it's heavily regulated, and the Department of Labor is now requiring that projections that get done by these companies, they have to be accurate. And if they're not accurate, then the valuation firm needs to work and really analyze how much should they be using them, or should they be pushing back and say, go develop another set of projections because these are not reasonable. So projections are a really important tool that gets used to determine value for a company. And we have to really look at whether or not they are reasonable, whether they are based on strong assumptions that are defensible, that we can make arguments around why this could happen, or if they are just very unrealistic based on historical numbers, then we have to look at that, and we have to apply additional discounts because of the unlikelihood that the company will meet those projections. That's what we're required to do. Another thing that's really important is, what does the company's products and services look like? Do they have a strong set of products and services, or is it, commodities? What does it look like? The technology is really important. Do they have an IP advantage? Do they have a set of IP portfolio that really sets them apart from their competition? Do they have a strong management team in place? What does their customer base look like? Is it a diversified customer base, or is there one customer? That's a problem. Customer concentration is a huge issue that needs to be dealt with in valuations. Does the company have financial and accounting controls in place? Are there reporting systems in place, not just at the management level, but at all levels of the company? Does the company have financials in place? Are they tracking on them? Are they reviewing them? Many companies have them done, but they don't actually review them, and they're not using them to determine what to do next, and they should be. Some of the risk factors, some of them we talked about, but if they don't have a strong management team in place, that can really bring the value of that business down. That has to be analyzed. If their financials have not been trending well, that's another reason that the value could come down. What about working capital? If the company is highly leveraged, that's going to bring the value down. So we have to be looking at, what are the issues, what are the reasons why the value of the business could be brought down. And these are actually all of the opportunities that we in the exit planning arena, these are the opportunities that we have to get in and work with customers when we see these risk factors, to come in and to try and help them make the improvements so that they can turn them into value drivers instead of being risk factors. So, the fact that they may not have any operational controls in place, they may not have any processes in place, they may not have systems in place, all of these things, need to be addressed. And all of these things are going to bring the value of the business down. So again, to go through, we've talked about what are some of the pros and cons of recasted financials, but some of the pros on having a certified valuation done, you're going to get a more accurate determination of the value of the company, of the real value of the company, because you're doing a comprehensive analysis of that business. You're also going to be providing a baseline value for that company. In a lot of instances, a company may not have had a valuation done, and so this is going to provide them with that baseline. We talked about industry and regulatory standards. And it also, we talked about the fact that it identifies the strengths of the company, and it also provide you with the weaknesses and those areas that need improvement. Some of the cons: it is more expensive. It's always more expensive than recasting, and it takes more time. To have a certified valuation typically takes about 30 to 45 days to get done. So, I have a couple of examples that we can go through. Or Drew, if there are any questions, do you want to open it up for questions, or do you want me to continue going through the examples?
Well, we do have about 10 minutes left of the presentation, Melissa. So if you want to go through one example, then we can field questions and then kind of lead people back into their day as well. That could work.
Okay. So this first example that I included here is an actual company that had a patented line of, they were healthcare products, skincare products. And at the time that the evaluation was being done, there was a decline in the market. The company was seeing a steady decline year over year. We had a situation where the bank brought us in. The owner of the business entered into an agreement with a buyer, and they came up with a purchase price of $1.5 million for the business. And again, this was based on recasted financials. So you can see there what the EBITDA and what the multiple were. The bank brought us in because they were going to be doing a loan for the buyer, but the buyer also wanted to have the valuation done because the buyer did not want to overpay for the business. So we came in and we determined that the assets of the business were worth about $700,000, but the IP value, the intangible asset value, is worth about $2.7 million. And the discrete intangibles consisted of several patents that the company had on these products that they developed. And then there was also a tremendous amount of goodwill value because the business owner put a lot of efforts into developing a very diverse customer base. So we actually came up with a fair equity value of $3.4 million, which included both the tangibles and the intangible assets. And there was a multiple of 4 times EBITDA on the valuation. So you can see that the feasibility test was 20.74%. So essentially what happened was the buyer got a great business. He got a great deal for this business, and the seller lost out on a few $1,000,000 because he didn't understand the value of his business. He didn't understand the value of the intangible assets, and he didn't have any valuation done. So, when you're utilizing valuations, it's really important to have an independent valuation done because it really allows the business owner to understand what their baseline value of the business is, and then to make a decision, is that enough? Is that what I want to get for my business? Or do I want to work on my business and maybe focus on increasing the enterprise value of the business so that I can get what I want when I'm ready to exit? So again, it positions the company for a higher valuation when they're ready to exit, but that's based upon making the improvements and the enhancements to the business. It also gives business owners a barometer of how well their business is performing. It tells you what the strengths and weaknesses are so that from year to year, you can work and focus on the weaknesses and make sure that you're turning them into strengths. It also allows, if you're going to take your business to market, the valuation provides a lot of information that will help you to position your business from a position of strength and look at the compelling attributes and take your weaknesses and identify them, because you want to make sure that you're acknowledging them, but then turn them into a strength. And of course, it gives a lot of credibility and a lot of support for the negotiations that you're going to enter into with potential buyers. And a few other things. When you negotiate that purchase price, that purchase price is that's kind of the ceiling. That's as much as you're gonna get. And so the valuation, when you have a certified valuation, it provides you with a lot of reasons that support justifying the purchase price that that the business owner wants to achieve. And then again, if there's any control premiums or any premiums that are included, it's going to provide the justification for why those premiums were included. Now, it'll do the same thing for any discounts. It's going to provide defensibility. So there are a lot of times where you're looking for a low value, not a high value, and we need defensibility for why did we take those discounts. And so it provides that. The intangible asset value, it provides an understanding of how those intangible assets were valued and how we came up with that price. And then, of course, you want to make sure that if the business owner is looking to try and get all the tax savings that they can, that they have the ability ahead of time, in advance, well in advance of a transaction, being able to set up these asset protection trusts and being able to transfer assets out so that they can transfer the business in the way that they want and still be able to maximize their tax savings. And that's what we were talking about with the gift valuations. That's what those gift valuations do, is allow you to set up these asset protection trusts and take assets out of your estate. So with that, that's all I've got for you. So let's open it up. If there's any questions, I'm happy to answer anything.
Yeah, we had a few questions come over, Melissa. So first question came through. Are there any general formulas for the discount minority interest will receive?
So there are a number of discount studies that are out there. We don't typically use the discount studies that are out there. We actually have an analysis. There is a flagship court case called Mandelbaum versus Commissioner, and that court case provided a number of factors that need to be analyzed as part of any discount valuation. And so we look at those factors. There are factors around control and there are factors around marketability. We take those factors, and those are not the only factors, but those are some of the factors that we analyze as part of a discount analysis. And we use that to determine what is the appropriate discounts to take for lack of control and lack of marketability. But yes, there are some studies out there that have general parameters in them.
Perfect. This next question is a two-part question. In a small business, customer concentration is oftentimes present. How much does that hurt your multiple? And for smaller businesses, what are the EBITDA multiples you're seeing? You mentioned they're quite appealing in this environment.
Okay, so all right, so let's take the customer concentration issue first. Customer concentration is a very big deal, and it is a heavy discount that gets added to the value of the business. However, so it can really bring the value of the business down. However, I will tell you that I recently, is about a year ago, I did a valuation of a company that had one client. That one client was doing very well, and as a result, even though if that client went away, the company that we valued, their whole revenue stream was going to go away. There's no question about it. But because of the volume that they were doing, the company was still valued very well, because there was just so much volume that was coming in. But it's a heavy deterrent, and it's a very big weakness that needs to be addressed. Anytime I see a company with customer concentration, that is the number one thing that we try to help them resolve, because it's a huge risk for anybody. Now, with regards to the other question about the multiples, so it really depends on the industry, and it really depends on how well the company is doing. But I can tell you that some industries that are seeing very high multiples include technology, healthcare. Those types of companies, you could be seeing anywhere from 8 times EBITDA to 12 or 15 times EBITDA. Manufacturing, services, other distribution, those types of companies, we're still seeing things in, I would say, 3 to 5, maybe 3 to 6 or 7 times EBITDA. When you get into aerospace, Food companies especially are going to have higher multiples. Aerospace companies could have higher multiples. So it really, really depends on the industry and how well the company is performing as to what the multiples might be.
Perfect. And then final question that came through for you, Melissa. Are there any softwares or products that you would recommend to help the valuation process?
That's a really good question. So I'm not the best person to answer that question because we do valuations and we do large volumes of valuations, but we developed our own model because what we saw was that the technologies that were out there were not achieving what we wanted to achieve, and we found that we could develop a model that was robust enough and met all of the parameters and regulations that we needed to meet. So we have our own model that we've built and we've used, and I've used it for at least a long time. But there are a lot of technologies out there. There are a lot of software products. You just really have to analyze them, be careful, and just make sure that if this is what you're doing, that they're going to meet the objectives that you're trying to achieve.
Well, perfect. Well, thanks, Melissa. I appreciate you spending some time with us and going through everything today. Hopefully everyone on the call today learned something and can take something with them away. Again, I did record the webinar, so the recording will be sent out later today. Then if you have any additional questions, you see Melissa's information there. You could also send me an email here at the Exit Planning Institute, and I'd be more than happy to send those over to Melissa for you to get those answered. But with that, again, thank you very much, Melissa, for joining us today and kind of walking through it. To everyone online, thank you very much for joining us. We'll let everyone get back into their busy day today. But let me know if there's any additional questions, or just reach out to Melissa directly. So thank you very much, everyone, and hope everyone has a good rest of the day.
Thanks, Drew. Thanks, everyone.